Do you ever feel like your money should be working harder for you, but you're not entirely sure how to make that happen? Perhaps you've heard whispers of investing, maybe even dabbled a bit, but the sheer volume of options out there leaves you feeling overwhelmed. You're not alone. Many people find themselves at this crossroads, eager to grow their wealth but unsure which path to take. Today, we're diving deep into two popular avenues for investment that often get pitted against each other: Acorns and Vanguard index funds. We're going to break down their unique approaches, explore their pros and cons, and ultimately help you decide which one might be the best fit for your financial journey. Let's face it, the world of investing can seem like a secret club with its own language and handshakes. Terms like diversification, expense ratios, and ETFs can be enough to send anyone running for the hills. But what if I told you that building wealth doesn't have to be complicated? What if there were tools designed to simplify the process, making it accessible even if you don't have a finance degree? That's precisely what both Acorns and Vanguard index funds aim to do, albeit in very different ways. Think of it this way: imagine you want to build a house. Acorns is like a prefabricated tiny home that's easy to set up, requires minimal maintenance, and is perfect for getting started quickly. Vanguard index funds, on the other hand, are more like purchasing the land and the blueprints for a robust, customizable house that you'll build yourself with the help of a general contractor. It requires a bit more effort up front, but offers greater control and potentially larger returns in the long run. Both can get you to the destination of homeownership, but the journey and the final product are distinct. Before we delve into the nitty-gritty, let's establish some context. Why are we even talking about investing in the first place? Simply put, inflation is constantly eroding the purchasing power of your hard-earned money. Leaving your savings in a traditional bank account is akin to watching it slowly shrink. Investing, on the other hand, allows your money to grow over time, potentially outpacing inflation and building significant wealth for your future. Whether you're saving for a down payment on a house, your child's education, or a comfortable retirement, investing is a crucial component of any sound financial plan. Now, let's address the elephant in the room: risk. Every investment carries some level of risk. The stock market can go up, and it can go down. However, historically, over the long term, the stock market has trended upwards. The key to mitigating risk is diversification, spreading your investments across various assets, and a long-term perspective. Both Acorns and Vanguard index funds incorporate diversification as a core principle, which is a major point in their favor, especially for those new to investing. So, who are these two players, Acorns and Vanguard? Acorns is a micro-investing app designed to make investing accessible to everyone, even with spare change. It's known for its roundups feature, where it rounds up your everyday purchases to the nearest dollar and invests the difference. Vanguard, on the other hand, is one of the largest investment management companies in the world, renowned for its low-cost index funds and ETFs. They are favored among long-term investors who prioritize minimizing fees. Let's start with Acorns. Its primary appeal lies in its simplicity and automation. Imagine buying a coffee for $3.50. Acorns will round that up to $4 and invest the 50 cents difference. These small amounts accumulate over time, and before you know it, you've invested a significant sum without feeling the pinch. Acorns offers a diversified portfolio of ETFs, professionally managed and rebalanced automatically. They have different portfolio options based on your risk tolerance, ranging from conservative to aggressive. This set-it-and-forget-it approach is incredibly appealing for those who are busy, new to investing, or struggle with consistent saving. The pros of Acorns are quite compelling. Firstly, it removes the barrier of needing a large sum to start investing. You can literally begin with a few dollars. Secondly, the automation is a powerful tool for building consistent investing habits. Many people find it difficult to manually transfer money into an investment account, but Acorns does it for you seamlessly. Thirdly, the diversification is built in. You're not investing in just one stock, you're investing in a basket of stocks and bonds, which helps reduce risk. Fourthly, it's incredibly user-friendly with an intuitive interface. And finally, the educational resources provided by Acorns are helpful for beginners looking to understand basic investing concepts. However, Acorns isn't without its drawbacks. The primary concern revolves around its fees. While seemingly small, the monthly fees can eat into your returns, especially on smaller account balances. For instance, a $3 to $5 monthly fee can be a significant percentage of a $100 account balance. As your account grows, the fee becomes less impactful percentage-wise, but it's crucial to be aware of this. Another potential con is the limited control you have over your investments. While the professionally managed portfolios are great for beginners, experienced investors might prefer more direct control over their asset allocation. Additionally, while the roundups are a great starting point, they might not be sufficient for building substantial wealth quickly. For serious growth, consistent larger contributions are often necessary. Now, let's pivot to Vanguard index funds. When we talk about Vanguard, we're primarily talking about low-cost index funds and ETFs. What exactly is an index fund? It's a type of mutual fund or ETF that holds a diversified portfolio of investments designed to track the performance of a specific market index, like the S&P 500. Instead of trying to pick winning stocks, index funds aim to mirror the market's performance as a whole. The beauty of this approach is that it historically outperforms most actively managed funds over the long term, and it does so with significantly lower fees. The advantages of Vanguard index funds are numerous. Foremost among them are the incredibly low expense ratios. Vanguard is famous for its commitment to keeping costs down for investors. These low fees mean that more of your money stays invested and grows over time, rather than being siphoned off in management fees. This compounding effect of lower fees can translate to tens, even hundreds of thousands of dollars more over a lifetime of investing. Secondly, index funds offer broad market diversification. By investing in an S&P 500 index fund, for example, you're essentially owning a tiny piece of 500 of the largest U.S. companies. This inherent diversification significantly reduces risk. Thirdly, the passive nature of index investing means there's no need for constant monitoring or trying to time the market. You invest, and the fund tracks the market. Fourthly, Vanguard offers a vast array of index funds covering various asset classes, sectors, and geographies, allowing for highly customizable portfolio construction for more experienced investors. Finally, Vanguard's investor-owned structure means that its profits are reinvested back into the company to benefit its clients through lower costs and improved services. With that said, thanks for watching, and until next time.